Hello, everybody. This is Bennett Chaikovsky, and welcome to yet another intermediate accounting video. This is fun and exciting. These are accounting changes and error corrections, and we're now going to focus here on the error corrections. But before we focus on those errors, we're going to focus on this, which is my disclaimer and copyright notice, is that the information and opinions in this presentation are those of myself only and not my employers or affiliated organizations, including but not limited to Irvine Valley College and the South Orange County Community College District. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2026 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. Throughout the presentation, I will make reference to publicly available information that is a copyright of other parties. I do not claim any right to those copyrights. Okay. Errors. Okay, these happen, right? And the best thing I can kind of tell you to do is that if you do make a mistake, we own up to those mistakes and we move on. That's the best possible thing you can do. By the way, I want to apologize to my 2022 intermediate accounting class that took me in the spring of 2022 because I had a bad answer key that I just only realized until now in 2026. But how did I make up for that? I gave a really good curve. So there you go. But hey, we all make mistakes. So what is an accounting error? It results from a mathematical mistake, a mistake in the application of generally accepted accounting principles, the oversight or misuse of facts that existed at the time the financial statements were prepared, or using an unacceptable accounting principle. Now, this also goes towards is we want to be like, why should companies be hiring CPAs in important accounting functions? Well, you hire CPAs in important accounting functions because if we screw up, well, if we will make mistakes, but if we make mistakes, not only can we get fired, however, we can also lose our license. And trust me, you will not want to lose that license. We're going to make mistakes, but that's why when we are preparing our financial statements, we have a lot of people overlooking our work, right? Hopefully you have a lot of people on board. But let's just kind of go through some common errors. Mathematical error, right? So maybe there was an addition mistake, wrong GAAP method, using an unacceptable inventory method, omission, forgot to record accrued interest, misclassification, reporting a capital expenditure as an expense. So how are these errors corrected? Okay, so you can have a prior period adjustment, and basically these are going to be errors are corrected by making an adjustment to the beginning balance of retained earnings for the earliest period presented. So again, we're not going to, you don't want to put an error into the current period. Rather, what you're trying to go through and do is to kind of say, all right, what's the impact? What's that current year impact on this? And we'll go through some examples that better explain it than the word salad I just gave to you. So how do we correct the error? Is that we identify the error and determine the periods effective, calculate the after-tax effect of the error, record the prior period adjustment to retain earnings. Again, you probably saw this when we were in intermediate accounting 1 and going through and doing discontinued operations and talking about retained earnings and, when do we put things onto the income statement. And over here, we're going to go ahead and restate the prior period financial statements, clearly stating that they are restated, and then disclose the nature of the error and its effect. And we are not going to include error corrections from prior periods in current year income as if the error is from a different time period. This is why we're going to be adjusting beginning retained earnings. That's where we put those errors. So over here, and I don't know if this is actually correct or not, but if facts in year 1, the company failed to report accrued salaries of 20,000, the error is discovered in year 2, assume a 25% tax rate. So we have over here the admitted expense was 20,000, and then here is your correcting entry basically for year 2. I want to say right now that I don't think that this is correct. So I'm just going to pause this real quick. I shall go ahead and leave this in there. This may actually be correct because if we're saying that the after-tax effect of the error is, if we're putting this onto our statement of retained earnings, And if I owe salaries payable of 20 grand, income taxes payable, I'm not sure if I would put it there, but you can't put it as an expense. It has to go into a category. So the impact to retained earnings, so in this case, would be in fact 15,000. But I'll go ahead and look at this in a future example. Okay. So balance sheet errors versus income statement errors. Okay, so there's two categories of errors. Balance sheet errors only affect balance sheet accounts. Examples of this: misclassifying a long-term liability as a current liability. Just we're going to go ahead and reclass this. There's no impact on income. However, we will want to disclose, and we will want to go through and basically say as restated, because if we are changing a prior period, then that's going to affect the current period. Income statement errors affect only income statement accounts. Examples: recording a revenue item is another type of revenue item. Again, we classify it, no effect on net income or retained earnings. This would be a revenue misclassification. So if we were reporting it, say, for revenue for one division instead of another, then we would just go ahead and put as restated. So again, you would still have to say that you're restating part of it, again, because you made an error on that front. But then when we have essentially a combined balance sheet and income statement error, which impact both, is that you're going to need to make a prior period adjustment to retained earnings, as we just saw in the last example. Okay. So counterbalancing errors is one that will automatically correct itself over 2 accounting periods. For example, if any inventory is overstated in year 1, net income is overstated because you took ending inventory reduces the amount. A higher ending inventory is going to basically reduce the amount that went to cost of goods sold. So your net income is going to be overstated. In the second year, your net income is understated by the same amount. So then after year 2, the retained earnings is absolutely correct. So in the error year, your effect on net income is overstated versus understated in year 2. The effect on retained earnings is our retained earnings is overstated. And then this finally goes through and correct it. A non-counting, this is a counterbalancing error, but a non-counterbalancing error is not self-correct. It must be specifically corrected with a journal entry. So here is that if you do in fact have a counterbalancing error, you would want to still go through and correct it. And because your financial statement information is incorrect, we don't want to show that to our investors. But a non-counting counterbalancing error would be capitalizing an expense that should have been expense. And because this would impact depreciation multiple years going forward. So this is kind of the approach that I share with my students: is go ahead and you want to identify the error, what was recorded incorrectly or not recorded at all, which accounts are affected, determine the periods affected. Did it occur in a current period or a prior period? Is it counterbalancing or non-counterbalancing? Calculate the dollar effect before and after tax, because if you have to hit retained earnings, then we're going to have to go through and make that done. Prepare the correcting journal entry. If it is a prior period, we're going to have to take on retained earnings, and then we have to go through and disclose the error and its effect on the financial statements. So, and in terms of disclosure requirements, like what do we have to go through and do for changes in accounting principle? This kind of goes back to the earlier deck we went through: change in estimate and then the correction of an error. So over here, a change in accounting principle, the nature and justification for the change, the effect on current period net income and earnings per share, cumulative effect on retained earnings, and then the effect on all prior periods presented. So we're going to have to show everything as restated. Change in accounting estimate, the nature of the change, current period net income and EPS. Prior periods are not restated, so we don't have to go through and show this as restated. Correction of an error, nature of the error, the effect on each prior period presented, the effect on beginning retained earnings, and then the effect on net income and earnings per share for each period presented. Okay, so this is just kind of like basically a summary, is like how do we go through and handle these different types of things. Remember, the one exception, if it's impractical to do so, we only handle that prospectively. And I kind of showed you some examples in the last video, and I'll kind of show it to you again, where basically the FASB or Securities and Exchange Commission will give you essentially options for handling things like, for example, over here, like beginning in 2025 annual reporting, we adopted ASU, that's not Arizona State University Accounting Standards Update 2023-09, improvements to income tax disclosures on a prospective basis. This standard improves the transparency of income tax disclosures by requiring consistent categories and greater disaggregation. It also includes, so again, we have to look towards the guidance in terms of what we're going to be going through and doing. By the way, one of the things I love to do is that see all these really good disclosures. Wow, if Meta Platforms is using this, they probably spent a lot of money on attorneys and advisors writing up this stuff. I'm going to copy this right away. And the Securities and Exchange Commission encourages that type of plagiarism because, hey, if this is written this well, I want to use it too. And in fact, that's really with SEC filings. You want to use things that have already been previously disclosed by other companies because if the SEC didn't give a comment on it, then we want to go ahead and use it. So you got to change an accounting principle, something that's impractical, or perhaps if it gives us the option to go through and to do so. Change in estimate is going to go ahead and be handled on a prospective basis. Change in estimate affected through a change in principle. That's, again, that was the depreciation example. No and no, it's not going to basically, it's going to kind of be through this. And then lastly, the correction of an error is we will have to go through and adjust prior periods depending on the nature of the error. So again, it's a prior period restatement, and then it's a going to be a retained earnings adjustment. So I want to thank all of you for watching. Please remember to like and subscribe. If you feel free to leave a comment or send me an email to ivc30cpa@gmail.com if you have any questions about any of the information I put up here, or if there's a particular question you would like me to go through and review. The next two videos I'm going to be making for you will be focused on different questions related to errors and changes in estimate, as well as errors, changes, and estimates, as well as, let's see, we'll also do a change in accounting principle. So thank you so much. I look forward to seeing you on the next video. Have a great day.